Welcome to Angel Impact, the official podcast of the Wisconsin River Business Angels. Episode 21, Key Differences Between Angel Investing in Mutual Funds, Part 2.
Yeah, I think, I don't know, what might be helpful is to talk through, like, what are four advantages of mutual funds, and then what are four advantages of angel investing, you know?
Sure.
What do you think, guys? Can you list, what are four advantages of mutual funds? Can you come up with some of those?
Sure. They have fund managers that do this for a living.
Yeah.
So they manage that portfolio.
So you don't have to think about it, right?
You don't have to think about it.
Yeah.
And in some of the companies that manage mutual funds will take an active role in your portfolio.
Okay.
And again, we have a portion of our investment where we have a portfolio manager that manages the types of mutual funds we have in our portfolio.
Okay.
The next level down is each one of those funds has their own fund managers.
Yep.
And they manage the individual companies that make up that mutual fund. And it can be, Leon, how many hundreds, maybe thousands of companies that the mutual fund might hold investment in?
Yeah.
Well, there's probably several thousand mutual funds, and each one will have anywhere from 50 to 500 investments in it.
Yeah.
Yeah. So yeah, I think the convenience of the mutual fund is great. A lot of the retirement programs that companies are set up investing into mutual funds.
Yeah. Yeah, Leon, what's a key advantage of mutual funds that you would express?
I'd say one of the advantages, you pass over your money and give it to them and forget it.
Yes.
Almost, to sleep at night, if you will, a sense of security.
Yeah, security. Yeah.
Mm-hmm.
Yeah.
But really, it may not be. But anyway, that's their belief.
Yeah.
Right.
Yeah. Oh no, I generally
you look at one number, simplicity. It's easy to understand one number.
Yeah.
How much did my mutual fund portfolio grow over this period of time?
Yes.
You look at one number.
Yeah. Yeah.
So there's simplicity.
Yep.
In understanding how your money is growing.
And most people believe that they're going to get better than the market, and they're not. It's a false sense of security. Well, but that's not what your question was.
Right.
Your question was
that's a disadvantage, I guess.
That's a disadvantage.
Yeah.
Yeah.
But okay, so key advantages of mutual funds, that I'm hearing are
they're big. They can participate in big opportunities, big companies, because they got a lot of bucks usually.
Okay, so strength in numbers, or strength, like crowd strength, kind of, right? Or
numbers of investment into dollars in the total pot.
And instant diversity. When you buy a mutual fund, you are already diversified.
Right.
Now you can diversify with different mutual funds.
Yeah.
That's your portfolio.
Yeah.
But every mutual fund that you buy automatically has a diversification.
Of the sector,
by definition of that sector,
the sector they prefer, and then the sectors can be agglomerated to give you another sense of distribution.
Yeah, I think one other advantage I see in mutual funds is that you can find one that fits your values, because there's a lot of mutual funds that will...
I don't think you can on your own. I think you can with somebody's help that really understands all the options.
All right.
The uninitiated is not going to be able to do that. They need a professional to give them some guidance.
I think in a general sense, you're correct in that, for example, if you are a strong advocate of zero carbon emissions, you're not going to invest in mutual funds that are heavy into fossil fuels.
Yeah, right. Yeah.
In that regard, yes, you can select by your value.
Yeah.
By your values, I should say.
Yeah. So simplicity. In other words, you have one number, instant diversity, ease,
and then it matches your investment criteria, your value system.
Your values, yeah. No, that's good. Yeah,
you could
and then
you could craft the selections to your values.
Right. And then there's sort of a perceived security that
risk security.
Yes. There is a perceived security. Yes.
Perceived security, which may not be real security, but it's I think that does give people comfort, though, right?
talk to anybody that had mutual funds during 2008, 9, 10, see what happened to their mutual funds. Well, so it is perceived security.
How did angel portfolios do in that? You know, do you have any idea?
I don't know. I wasn't involved. Leon, you were.
Typically, they would have slowed down in the amount of investing. There may have been some that went down in the two because they weren't able to survive that environment, but that was rare. Overall, they tended to probably stay the same value, increase a little bit, or go down a little bit, but they were still there as a company, unless they terminated their service. But that's happening right now, today.
Right now, yeah.
Yeah. Well, I mean, it seems, it strikes me angel investing is such a, it's such a, like a, rarefied slice of the economy that
it is.
It's not going to, it's just not going to respond the same way to like a total market index or, anything that's so broad, right?
Well, here's another interesting perspective on that. Entrepreneurs, by their very nature, thrive during disruptive periods.
Sure. Yeah.
When markets are disrupted, that's when opportunity presents itself to startup companies.
Right on.
Because all the old relationships and the good old boy contracts and everything, they all fall apart when things get uncertain. And there's always opportunity for entrepreneurs that have vision and also understand that turbulent times are actually the best times for opportunities for startups.
And one of the key things for an entrepreneur to get going is to have an opening in the marketing. This turbulence creates that opening. So they now can come in, say, hey, we have a solution to this sort of thing. And wham, people say, wow, that's right. Yeah. Man, they can take off, and that gives them the basis for the future.
There is another distinct difference is that even mutual funds, when a mutual fund starts to move out of one investment in one company into another, that movement, it actually moves the market on those commodities. So when they start to sell, that price starts to drop. When they start to buy, that one starts to go up. So they have to be very careful in how they move from one to another. And they usually do it very slowly, because if you do it rapidly, again, you're merely making those big transactions, you move the market. So they go slowly. And by going slowly, think of yourself as the Queen Mary trying to navigate. You turn the ship very slowly. At the angel investment level, you can turn on a dime.
All right. Yeah.
You don't have that impact on the market that you're depending on for your earnings.
Yeah. That's very interesting.
Thanks for listening to Angel Impact, the official podcast of the Wisconsin River Business Angels. To learn more about the Wisconsin River Business Angels, visit the website at www.midwestwealthventures.com or find us on Facebook.